Hello viewers, let's explain the concept of risk tolerance in investing today. Understanding risk tolerance is crucial for investors, as it helps them make informed decisions aligned with their financial goals and comfort level with uncertainty. Here's an explanation of the concept of risk tolerance in investing. 1. Definition of risk tolerance. Risk tolerance refers to an investor's ability and willingness to withstand fluctuations in the value of their investments, or the potential for loss in pursuit of achieving their financial objectives. It reflects an individual's comfort level with taking on investment risk, and can vary significantly from one investor to another based on factors such as age, financial situation, investment goals, time horizon, and personal temperament. 2. Factors influencing risk tolerance. A. Time horizon. Investors with longer time horizons, such as young professionals saving for retirement, may have a higher risk tolerance as they have more time to recover from short-term market fluctuations. B. Financial goals. The specific financial goals of an investor, such as saving for a down payment on a home, funding a child's education, or building a retirement nest egg, can influence their risk tolerance. Goals with longer time horizons may allow for more aggressive investment strategies. C. Financial situation. An individual's financial situation, including income, savings, debts, and assets, can impact their risk tolerance. Investors with stable income, ample savings, and low debt levels may have a higher risk tolerance compared to those facing financial constraints. 3. Assessing risk tolerance. A. Risk assessment questionnaires. Many financial advisors and investment platforms offer risk assessment questionnaires designed to gauge an investor's risk tolerance. These questionnaires typically ask about factors such as investment goals, time horizon, financial situation, and comfort level with risk. B. Scenario analysis. Investors can also assess their risk tolerance by considering hypothetical investment scenarios and how they would react to various market conditions, such as significant market downturns or prolonged periods of volatility. 4. Implications for investment strategy. A. Asset allocation. Risk tolerance plays a crucial role in determining asset allocation, or the mix of investments in an investor's portfolio. Conservative investors with lower risk tolerance may prefer a more significant allocation to low-risk assets such as bonds or cash, while aggressive investors may favor a higher allocation to equities or alternative investments. B. Diversification. Diversification, or spreading investments across different asset classes, sectors, and geographic regions, is a fundamental risk management strategy. Investors with lower risk tolerance may prioritize diversification to reduce portfolio volatility and minimize the impact of individual investment losses. 5. Monitoring and adjusting risk tolerance. A. Regular review. Investors should regularly review their risk tolerance, investment objectives, and financial situation to ensure alignment with their investment strategy. Life events such as marriage, career changes, or nearing retirement may warrant adjustments to risk tolerance and portfolio allocation. B. Market conditions. Market conditions and economic factors can influence risk tolerance over time. During periods of market volatility or economic uncertainty, investors may reassess their risk tolerance and make adjustments to their investment strategy accordingly. 6. Conclusion. Understanding risk tolerance is essential for investors to construct portfolios that align with their financial goals, time horizons, and personal preferences. By assessing risk tolerance accurately, investors can develop investment strategies that strike the right balance between risk and reward, and navigate the complexities of financial markets with confidence and resilience.